Yesterday was a big day, guys. It was NFP day. The labor market is weakening. NFP came in lower than forecast. ADP was significantly below expectations. Unemployment rate rose to 4.1%. Consumer spending is contracting. Retail sales came in at -0.9%, missing expectations. The combination of slowing growth, stubborn inflation, and a weakening labor market suggests stagflation. Federal Reserve likely actions. The Fed will likely tilt dovish, but no immediate rate cuts. Here's why. Growth is slowing, but it's not a recession yet. GDP has declined. Job growth is weakening. But the economy is not in a deep contraction yet. Unemployment is rising. The rate has climbed to 4.1%, signaling labor market softening. Inflation remains above target. Core CPI YOY 3.3% is still sticky and above the Fed's 2% target. PPI 3.5% suggests that inflationary pressures are not fading quickly. Weak labor market signals a future rate cut. NFP 151K was below expectations, 159K, indicating slower job creation. ADP 77K was a major miss. Private sector job growth is stalling. Rising unemployment claims, 2 and 21K, confirm labor softening. So what is the Fed's possible course of action? No immediate rate cut. Inflation is still above target, preventing a rapid rate cut. Dovish shift. The Fed may signal future cuts if job losses continue. Data-dependent approach. The Fed will wait for more evidence of slowing inflation and weaker jobs data. Rate cuts possible in Q2 or Q3. If labor conditions worsen, we could see cuts in June or July. In short, the Fed is likely to pause and monitor data. But if labor conditions deteriorate further, rate cuts could come sooner than expected. How does this impact gold? Given this stagflationary environment, slowing growth, stubborn inflation, and a weakening labor market, let's analyze how gold is affected. 1. Weaker labor market and growth. Rate cut expectations rise. Gold benefits from lower interest rates. 2. Sticky inflation. Hedge demand increases. Investors may turn to gold as an inflation hedge. 3. Risk of economic weakness. Safe haven demand rises. Gold benefits if fears of a deeper slowdown increase. This suggests bullishness for gold. Looking at our scoring system, gold is printing bullish with a plus 2.42 score, meaning we should be looking for buys only. Now let's go to the charts and see where we can look for buy opportunities. If price retraces to 2,900, which is a strong support level, I'll be looking to buy. First take profit, 29.50. Second take profit, 3,000. Dropping down to the 4-hour time frame, price has been ranging between 29.25 and 2,900. Since we're only looking for buys, we'll wait for a break and retest of 29.25, then enter buys. If price breaks below 2,900, we might see deeper retracements to 28.75 or 28.50. These are key buying zones. I'll be sharing all these signals on my free Telegram channel. Join if you're interested. Link in the description. Silver analysis. Silver is actually a little stronger than gold with a score of plus 2.96. Final target, 35.0. Looking at the H4 timeframe, price is hovering around 32.527. I'd love to see price clearly break and retest this level before buying. First take profit, 33.75. Final take profit, 35. Now, let's analyze currencies before moving on to stock indices. What I'm about to say is a bit complicated, but I'll try to simplify it. Currencies are traded in pairs. If one country's economy is doing better than the other, its currency will appreciate. Let's take a look at your USD. USD is currently the weakest currency. Why? US data is missing expectations. Retail sales 0.9%, consumers are slowing spending. NFP 151K, weaker than previous months. ADP 7K, major slowdown in job growth. These weak numbers increase speculation that the Fed may cut rates sooner than expected. As a result, traders started selling USD. And by traders, I don't mean retail traders like us. I mean institutions, banks, and hedge funds, the ones who actually move the markets. Looking at institutional positioning, on January 14, USD's rate of change was 494.882. It has now dropped to 3.79. Meanwhile, EUR's rate of change increased from 8.79 to 82.76. This EUR-USD strength is why combining institutional positions with economic data is so important. Price action alone is like traveling to a new place without a map. Yes, you might reach your destination, but you could get lost along the way. Institutional hot data and economic data serve as a map, giving clearer direction of where price is going. Is this a pullback or a true trend reversal for EUR-USD? More likely, a pullback until we get confirmation of actual Fed rate cuts. Let me explain. The US economy is stronger than the Eurozone. The ECB is likely to cut first, while the Fed is waiting. Interest rate differential favors USD, making it more attractive. The US is still growing faster than the Eurozone. The Fed is holding rates at 4.5%, while the ECB is already cutting. Meanwhile, the Eurozone's growth is much weaker, making the EUR less attractive. GDP growth, 0.2%, 2.3% USD stronger. Manufacturing PMI, 47.6, contracting 52.7, expanding USD stronger. Services PMI, 50.6, barely growing. USD stronger. Unemployment rate, 6.2%, 4.1% USD stronger. Retail sales near 0.3%, declining 90.9%, weak, mixed. CPI inflation 2.4%, falling 3.0% higher. USD stronger CPI inflation 2.6%, 3.3% USD stronger. Interest rates 2.65%, 4.5% hold USD much strong. EUR-USD bias bearish, sell US list. Key reasons. 1. US economy is stronger than the Eurozone. 2. The ECB is likely to cut rates first, while the Fed is waiting. 3. Interest rate differential favors the USD, making it more attractive. Should we sell EUR-USD? No. We should continue looking for buys until we see a shift in economic data, institutions gaining confidence in USD. For now, we can continue to buy, but with caution. EUR-US trade setup. Looking at the daily chart, I'll be looking for continuation buys. 1.70 looks attractive. This is a strong support zone. First target, 1.10. Dropping down to the H4 time frame. If we break and retest 1.0875D, I'll also buy from there. Once we reach 1.10, I'll pause and monitor what the Fed and ECB do next. Final thoughts. This video took longer than expected, so let's pause here. If you found this valuable, don't forget to like, share, subscribe. Also, join my free Telegram group for more free value, link in the description. See you in the next video.